Hello, everyone, and welcome to another Capra Asia webinar, this time looking at the future of programmable money and cross-border payments. We're really excited about this session, and it's one of the topics that a lot of people have talked about, but we haven't really seen in the webinar context. So I'd like to introduce my panel today, a fantastic group of people that really have a lot of expertise in this space. First of all, we have Tony from Citibank, Philip from JP Morgan, and Diraj from Finastra. And as we get into the questions, I'd like each of them to introduce themselves and share a little bit about their focus on programmable money, and then obviously get into the details of what they're seeing on a regular basis. We are operating this webinar in listen-only mode, but if you do have questions, please do use the chat functionality and the Q&A functionality to send them through. Oftentimes we don't get to all of the questions that we have, so if we don't get to your question, we'll answer it offline when we finish. So let's get into it. And Tony, maybe let me start with you. I mean, to kind of level set around this, how would you define programmable money, and what distinguishes it from kind of other traditional forms of digital currency and payments?
Thanks, Zen, and you asked me to introduce myself briefly. So I'm Tony McLaughlin, and I work in the payments business at Citibank. So very nice to be with you today. So programmable money, I think you'd have to go back to the root in terms of where this concept has come from. The original Bitcoin network was not, generally speaking, programmable, and Vitalik Buterin created the Ethereum network. And the massive difference between the Bitcoin network and the Ethereum network is that Ethereum is essentially a computer system. It's a Turing complete computer against which you can write code. And so that introduced the idea that you could have tokens representing value on a network, and that network itself being Turing complete, the ability to write computer programs against it. People call them smart contracts. And that's where the concept of programmable money arose.
Great. Philip, let me come to you on this. If you could intro yourself, and then what do you see as some of the key features and functions that programmable money can offer in the context of real-time cross-border payments? Well, cross-border payments in general, and then potentially real-time cross-border.
So yes, thank you, and thank you for inviting me to the podcast. So I'm Philip Ness. I head up business development globally for Onyx in JP Morgan Coin Systems. And so we're very proactively looking at programmable money, and to some extent, in the broadest terms, programmable money, because I'll come on to how we view it at JP Morgan later. But we also see it as a key differentiator from some of the things we've rolled out already within JP Morgan. I think most people are familiar that we've been live for a couple of years now with JP Morgan Coin, a blockchain deposit account that's a single bank blockchain running on the Quorum Ethereum protocol that is built out for our own JP Morgan customers globally. But the differentiator, because we could have built that out on any technology, the reason we chose blockchain technology, in particular the Quorum Ethereum technology, is, as Tony alluded to, the ability to write smart code against that. And programmability, we believe, differentiates what we're doing and can do going forward. And there's some base level kind of table stakes, which is around 24/7 transparency, certainty, etc., in the movement of funds cross-border. And that's other technologies could do that, but where we see programmability and the underlying technology differing is the ability to develop smart contracts that allow us to do some really interesting things in terms of maybe some simple automation, conditional payments, but then moving forward into more complex solutions such as maybe usage-based payments on IoT machines, for example. And ultimately, what we want to do is embed that capability in our client processes. So we come up with a term which is kind of standard in the industry, embedded treasury. But the embedded treasury parts allow clients far more flexibility than they've had historically to be able to define their own parameters for the movement of funds in our case, our own blockchain network within JP Morgan.
And Philip, I mean, when we talk about programmable payments and programmable money, it's kind of two different things, right? I mean, in terms of the definitions that we're looking at.
Sure, absolutely. I mean, certainly from our side, that's how we see it. I mean, we started with programmable payments is our entry point, and we'll discuss that later as we talk about some of the activities we're doing today. So we have programmable payments as a trigger event that triggers a payment, and in our case, that's typically a cross-border payment based on some event. But the concept of programmable money we define as the ability to program the actual money, so purpose-bound money, or allowing money to be used for a single or a couple of use cases, embedded in an account structure, is something that we're exploring in terms of, for example, having funds set aside for a particular activity, and that could be, I think, at the end of last year, the MAS did a project with a number of banks locally here in Singapore around purpose-bound money for payments to retail customers. So that could be, for example, in the COVID scenario, emergency payments to a retail client base on a purpose-bound money that this was set for that purpose. Not only on the purpose of in an account it can only be used for that purpose, but obviously going forward you could extend that it could only be used for that purpose. So limiting it to a number of outlets or for food purchases, etc., whatever that may be. So taking that back into the banking and wholesale space, for example, we're looking at some of the financial markets, wholesale banking kind of environments, for margin financing, CLS payments, for example, where people can actually have set aside funds and have those funds used for that, only that purpose within their account, and then react to a program event that says, use this money in this instance to meet this obligation. So that's where we're going, and that's how we differentiate programmable money in terms of actually programming the money to move, and also then the actual, an event or a trigger that actually is a programmable payment. I mean, I guess the difference might be subtle, but we've certainly kind of divided the two across those two lines.
Yeah, that's a really good point, and it's important to separate those definitions. Tony, I want to come back to you. I mean, in terms of the key features and functions, you've been looking at this for a while at Citi. Does everything that Philip mentioned resonate? Did he miss anything? Is there anything in addition that you're looking at that excites you about the possibilities here?
Yeah, well, I think to get at the difference between the kind of infrastructures that we've got today and the kind of financial infrastructures that we might have in the future, we have to explore what I like to call the tokenization thesis. And some people believe, and you will hear people expound this idea that in the future all financial instruments will be stored and transferred on some form of a blockchain. And if you scratch at that idea, why is it they believe that? What is this tokenization thesis? Where are the potential benefits? And I think to get to those, you have to compare existing financial infrastructures with public blockchains like Ethereum and say, what's the difference? What do you get if we move towards this more blockchain-based environment? And I can delineate three aspects which are interesting to explore. Number one, Philip did mention the 24/7 aspect, and frankly, almost nothing in traditional financial services is 24/7. I mean, the biggest markets in the world, the FX markets and the securities markets, don't run 24/7, and there's maybe a presumption that in the 21st century digital economy, finance should be 24/7. The faster payment schemes that we've seen growing up are the exception to prove the rule. Obviously, they do operate 24/7. The second thing is, and this is a much deeper point, Ethereum is multi-asset in a way that traditional financial silos are not. In banking, we have these special purpose infrastructures for given legal instruments. So RTGS systems only know money. Other systems like CSDs, they only know securities. So in Ethereum, you can have a token that represents money, another one that represents securities, another one that represents a letter of credit, and another one that represents, any other arbitrary digital asset, and they're all on the same kind of computer network. So it's multi-asset and less siloed in a way that we're not in traditional finance. And the third part comes back to this programmability, because when you have these representations of value on a common infrastructure, and if that common infrastructure is Turing complete, you can write computer programs against it. So what that kind of topology represents, or is a different way of organizing what you might call the database of money. At the moment, let's say that there are over 20,000 banks on the planet. Every one of those banks has their own data center. They have their own ledger within those data centers, and what we have in traditional financial messaging infrastructures is messaging between those databases, and market infrastructures that do one kind of thing. So the tokenization thesis is basically comes down to this: wouldn't it be great if we started to transact on shared ledgers which were Turing complete, programmable, and what efficiencies and innovation could be unlocked from that kind of setup? A contrast between the existing fragmented structure of our databases, which is currently represented by 20,000 plus separate islands of data.
That's a really great way to kind of think through this whole concept of programmable money and how it could completely change the financial infrastructure that we know today. Thanks, Tony. Diraj, I want to come to you. I mean, as a technology provider, can you share some of the insights that you're seeing from the clients that you engage with, and what types of players and entities are getting engaged with programmable money?
Yeah, thanks, Jaren, for inviting for this webinar. A quick introduction. I'm Dheeraj. Work for Finastra, and as part of our work, we help banks to adopt to this new payments emerging technology, and we are also closely looking at the programmable money as well as the programmable payments. So Jenna, before I touch on your questions, I just wanted to also add. Two aspects of programmable money and programmable payments, and I think Tony and Philip just mentioned it, right? So, I mean, we still see that industry uses interoperability, although those two are different things, right? And so one programmable payments was there since few decades, when even with the legacy payment system, with a little bit of automation for whether you call it the direct debit or standing order, or bit of managing the payments in a programmable mode. But what happened after the cryptocurrency technology? I mean, programmable money came in existence, right? I mean, the word is invented. So, in respect of two part, right? One is the ecosystem as well as what banks are doing. So, from an ecosystem perspective, the underlying technology is one key pillar, right? Whether we call it the blockchain, DLT, smart contract, this is one of the key pillar. And the other pillars like central banks, commercial banks, as well as your fintechs or DA providers, as well as the organization which is trying to set up the entity for stablecoin are doing something. So from a bank perspective, what banks are doing, right? It goes back again to the use case. I think we discussed about the cross-border part of it and how traditionally bank used to do the cross-border and the challenges which has, right, not able to do the 24/7 and efficiency and other things. So depend on what banks priorities are, what they are trying to achieve, what is the vision. So some banks are leading in this space, right? They will have their own ecosystem. You have two representatives today which has built a strong ecosystem surrounding the programmable money or programmable payments. There are other segment of banks which are not building by themselves, but they are looking at to participate in those chain or ecosystem. The third set of banks are which are either taking a part of pilot in the central bank CBDC projects, or just waiting for a full commercial rollout so they can do some activity there. So in short, there are multiple stages at the multiple banks, and it's still growing. And we need to see that how these all initiatives come to get a commercial life, and how banks wants to operate in that model.
Those are great points. Thanks, Raj. Thanks for setting out that ecosystem. Philip, one thing before we move on to regulation is the concept of account-based or token-based when we're talking about digital money. Can you, for the benefit of the audience, can you explain a little bit more about that and why that matters for programmable money?
Yeah, I guess I can kind of give pragmatic experience as an example. I mean, clearly, when JP Morgan launched JP Morgan Coin back a few years back, we would have preferred to have issued probably some form of a token-based asset that could be freely used outside of JP Morgan. But given the restrictions that are in place, the well-known challenges around the regulatory landscape, the treatment of the balance sheet, taxation, etc. What could we actually do to actually move things forward and get some hands-on experience? So we launched JP Morgan Coin, a blockchain deposit account that is basically an account-based solution within JP Morgan that allows us to offer our customers capability such as moving funds 24/7, 365 across our network that we couldn't do historically, including currency holidays, etc., using an account-based solution. And we can do some externalization of that via our API to third-party networks, using capabilities to lock funds, etc. So there's lots of things we can do to kind of move ourselves forward. But it's an account-based solution, and it is limited to JP Morgan clients. The entry point to owning a JP Morgan coin account is being a JP Morgan client. And clearly we work in a world where multi-bank is a prerequisite, and people would like to freely use and pass assets with the utility with more capability going forward. So we are exploring something, and there's some white papers and experiments with the MAS and SBI last year at Project Guardian around deposit tokens and creating a token that is freely available on a distributed finance network or a public permissionless network to allow that free use of that asset within the boundaries of something we're going to talk about later around the regulatory boundaries. So that for us is very different. We have an account-based solution that moves as an account. To all intents and purposes, it is a bank account. It's a liability on JP Morgan's books and records. It's commercial bank money. That doesn't change. So in terms of being able to move forward and bring along both internal and external regulatory and compliance partners, we were able to showcase that this was fundamentally the same kind of product, just giving some additional benefits, just using a different technology. Going forward on the token world, as we're about to discuss, that brings far numerous number of challenges once you take it forward outside of your organization and try and use a token and externalize that on a public permissionless network, for example. And I think we're about to explore that in subsequent questions. But there's an account-based solution tied to an account, and then there's a token that is more freely available and reusable outside in a wider marketplace.
That's great. Thanks, Phil. Tony, on the account versus token, and before we get into the regulatory side of things, any additional comments in addition to what Philip has kind of mentioned there?
Yeah, well, again, I think it's worthwhile going back to the roots of these things. And the original Bitcoin is a digital bearer asset, essentially, which means if you've got the private key, you've got control over the asset. And the truth is that for decades, we and regulators have been trying to really eliminate bearer instruments because of their usage in financial crime. And this goes back really decades where, FATCA and TEFRA back in 1982 started to disincentivize the usage of bearer instruments. And so I have to say, I remain to be convinced that returning to a world of bearer instruments is a good idea. So tokens are used as a kind of shorthand for a bearer instrument. And, back to this question about the distinction between money and payments. I mean, money in today's world is the liability of a regulated institution. Could be a central bank, could be a commercial bank, could be a regulated non-bank. But it's really a promise to pay the customer back at par value on demand in national currency units. So that's what money is. And a payment is the transfer of that liability from one institution to another. So at the beginning of a payment, Zenon, my bank owes me $100, and at the end of the payment, your bank owes you $100. I think it's not obvious that the best way of making payments is for me to pass you a liability of my bank, because you're just going to have to convert the liability of my bank into a liability of your bank if you want that money to be in your account. So I think the distinction between account-based and token-based isn't really getting to the heart of what we're talking about. The question really is whether we want to move back to a world of bearer instruments And I find it a high hurdle to pass because of the financial crime risks associated with bearer instruments.
Mm. Those are really good points. Philip, do you have any thoughts on the bearer instrument side of things? Would you agree with Tony in terms of we don't want to go back to that?
Sure, I kind of agree and disagree, frankly. Agree with the synopsis, absolutely. But I suggested is probably a couple of points I would make. Going forward, I suspect we're not going to the bearer instrument model in its most, purest sense. Is there a hybrid or a middle ground that kind of brings some of the benefits, but without going back to a fully managed environment? With the constraints that we see and have today with a highly regulated, restrictive landscape, is there a middle ground that we could move towards? And that's an open question, and we're exploring it with many others today. Is that possible? And I would suggest also that commercial bank money. I think there's a recent report by the BIS about 90% of the money in the world today is commercial bank money. That's a model that we've understood and have highly regulated banks in a system that kind of works today with some obvious challenges. It works today. Do we want to completely transform that going forward, or leverage that and tweak that to give some of the future benefits that the technology is enabling us to deliver, or do we want to do something else? And this is a debate and a question that I think we're all kind of exploring and trying to work out the best way forward. And everyone will have their own opinions and views. But I think from a JP Morgan perspective, I think we're quite clear on our side that commercial bank money, from our perspective, fairly obviously is the right way forward because, frankly, we're a commercial bank and we operate as a commercial bank, and that's something that we're trying to, bring benefits to our customers and the ecosystem within, without necessarily, to Tony's point, ending up in a bearer instrument world or a pure bearer instrument world where we're serious concerned about financial crime.
Great. Those are all really good points around the ideas and some of the theoretical elements behind this. I think one of the key questions is around regulation. Tony, I want to come back to you in terms of like regulatory treatment. What are the key challenges that you're seeing, both in general for the industry and specifically, as much as you can talk about it, for Citi itself? What are the regulatory challenges that you're seeing within the marketplace in terms of regulatory treatment or other hurdles that we need to get through? And maybe you can talk a little bit about what's happening with Mika, I'm not sure how to pronounce it, but the recent stablecoin regulation there in the EU.
Yeah, there's a core issue, which is that folks seem to be conflating two separate categories of question. So I think that clarity is brought to this space if you separate out legal instruments from the technology used to record them. So DLT is best considered as it's just a database. It's just a computer system. It just happens to be a computer system which is external to the bank or external to the institution. But it records. It's a ledger, shared ledger technology or distributed ledger technology. So it records entries on a ledger. Those entries can record existing legal instruments on a shared ledger as easily as on an internal ledger. And so I think one of the ways of getting clarity on this is to say that if a regulated institution can record a deposit or a security or a trade instrument on an internal ledger, if it was to move to record those things on a distributed ledger, the legal instrument has not changed, and therefore the legal treatment has not changed. What's really changed is a difference in the technology used to record that legal instrument. And what's really happening is a kind of outsourcing, because the bank was previously maintaining its own books on records on a proprietary system, and now it's maintaining its books and records on an external system. And even there's a well-worn path that banks have to walk and regulated institutions have to work called third-party risk management. If you're doing any kind of outsourcing, if you're outsourcing to a cloud provider, you have to do a third-party risk management assessment. And the same thing if you're outsourcing to any kind of external record-keeping system like a DLT. But this concept of separating the legal instruments from the technology used to record them is, I think, especially revealing when you look at how in the blockchain space, actors in that space have tried to argue that the technology drives new legal instruments without there being a framework to encapsulate them. So stablecoins, for example, are not known in most law. And yet you have issuers of these instruments who are using the technology to create what they claim to be expressions of value without there being a clear legal framework. In the blockchain space, there is this phrase called code is law. And this is a big confusion. Law is law. And just because something is possible on a blockchain doesn't mean it's legally permissible. And my humorous comment on this is that when laser copiers were invented, it made it easier to counterfeit money. It didn't make it legal to counterfeit money. And in the same way, just because it's possible to use this digital printing press, a DLT is a digital printing press, to create expressions of value, it doesn't make it legal to do so. So the core regulatory challenge, I think, is let's resolve these two questions into separate buckets. Number one is what kind of legal instruments are permissible? And the second thing is how are they recorded? And when it comes to recording existing legal instruments on blockchains, the hurdle that has to be passed is called third-party risk management.
Those are good points. I already see a couple of the quotes that we're going to pull from this webinar. Law is law, and blockchain is just a database. There was a whole there are a bunch of people here in Singapore. I could hear them shouting in the background as you said that, Bitcoin maximalist that says it's just a database. Philip, from the financial institution perspective, I mean, are there particular considerations that JP Morgan had to go through with JP Morgan Coin or everything else? I mean, would you agree with Tony's view of separating that, and was that effective in how you were able to separate the instrument from the technology in getting going at JP Morgan?
No, absolutely. I kind of concur with nearly everything Tony said. It kind of makes absolute sense. There's a phrase out there, same activity, same regulation. And that's what we've kind of been the mantra in terms of we're actually doing nothing different than we do today. We're just using a different technology to deliver, some enhanced features and capabilities. But underlying, it's the same. To Tony's point, the instruments don't change. It is an instrument that's been well understood. The regulatory framework of how to treat and manage those instruments is well understood, and we're respecting those. So, the standard regulatory requirements about secure, robust infrastructures, etc., are all in place, no different from yesterday. And that's what we're trying to do as we go forward. And that's the point that we're making. And I think Tony made the point very eloquently around we separate the two, because I think that's been something in the industry that, certainly from my background and experience, then that's always been the case. We've been interested in the technology and the features and functions it brings to the table, not some of the emerging digital asset types that are out there that are, the crypto assets that are traded, etc. So we're absolutely wedded to, there's a very well-worn path of existing regulation and capabilities that we're adhering to that stood the test of the time, is seen as a robust overlay, and that's what we'd like to adhere to. Now, going forward, as we move to a new paradigm and new business models, do we need to tweak those regulations to accommodate the new business models, particularly around the shared ledger environment? That's again an open question. But fundamentally, we're using existing instruments in a different format, and then using that technology to exchange value across those networks. And therefore, we don't need a fundamental change in the regulation. We just need to adhere to it and ensure it's applied uniformly across all participants.
Great points. Thanks, Philip. Raj, I want to come back to you. I mean, beyond regulation, one of the other challenges around here is interoperability. And, I think if we look at what's happening in Asia, there's so many different choices between, the traditional rails, real-time payment rails, other alternative rails like Visa Direct. How are you seeing banks look at kind of programmable money and digital money in this context in ensuring interoperability?
Yeah, I think it's a very good question, and we are seeing that multiple payments rails in the market, right? And some are traditional. I mean, some are traditional, some are new, which is still kind of traditional technology, but trying to solve the problem. And some are quite unique in terms of leveraging the DLT as a technology or leveraging the smart contract, as well as have the option to settle the funds without moving the fund. Basically, rather than using the fiat, can use an programmable money in form of whether CBDC or any commercial coin. So I think from a bank's perspective, uh, I mean, there are few consideration, right? I mean, how they standardize their strategy, right? Because end of the day, it's an there is underlying use case, and they have to send money to for a specific purpose, and there are a lot of systems to be integrated with the core system. So standardizing of the messages and integration capabilities. Third, the connectivity, because financial institution needs to connect with the other participant, whether it's a programmable money ecosystem or other financial institutions or internal technology. So connectivity is one of the important aspect. And fourth one is the security part, right? And at any point of time, the messages, the technology should be secure. So again, it goes back to the bank's vision and their stage and their scale. Some banks have made good progress, some banks are in the pilot mode, some banks are trying to explore what can be done to maximize the opportunity what they have in the market. But yeah, tech companies like Finastra, as well as any others, are also closely watching it and trying to bring the right solution to the market, so they can help a financial institution to prepare for the adoption of those new aspect of the money, which is programmable money as well as the programmable payments.
That's great. Thanks, Raj. And Philip, coming back to you in terms of the risks and challenges, I mean, we've hinted at a lot, we spoke about a lot. Is there anything we're missing here? I mean, are there other challenges that you see perhaps around understanding around this, or what else do you see inhibiting the growth of these forms of digital money in the future?
Sure. I mean, there's been an awful analysis and white papers on the subject, and a lot of academic thinking has gone into this. What the future holds for us. So I think that that's kind of understood. But the challenge is what we don't know. What are the unknown? And I think there's a lot of reluctance, certainly at the regulatory and kind of central bank level, in terms of that unintended consequences of anything that we might do. So they're looking to explore further before being able to move forward. So I suggest that from our perspective, actually doing something is far more important, because once you start doing something, you run into what are the other challenges and real world challenges that you face over and above ones that have already been identified. And as you explore that, and the various models you may move forward with. So from a JP Morgan perspective, we're doing things that we can do today, being very pragmatic and trying to give benefits to clients and value to clients by leveraging capabilities, as we move forward. But then also looking into the future, what does a CDBC world look like? What does a token world look like? And exploring that and finding out what the issues and challenges are. And they're numerous, frankly. I mean, I think there's a great phrase that comes out of the MAS every time they run one of their POCs. They stand up and say it's probably raised more questions than it's answered. And I think that's true, because once you start doing an activity, and I go back to Project Guardian last year, where there was an exchange of Singapore dollars for Japanese yen tokens intraday as a live experiment on a live distributed finance protocol. That raised a lot of questions. So some were solved around verifiable credentials. That kind of problem was kind of better understood and resolved, and probably meets the requirements of all the stakeholders. But then going forward, it raised a number of other open questions in terms of scalability, know your client regulation, etc. How do you incorporate all the other regulatory requirements and needs privacy, etc. going forward. So all those things still need to be worked through. But we're strong believers in actually experimenting to be able to understand what those challenges are, maybe resolving them with all the relevant stakeholders, and or understanding that something may not be able to move forward. We've explored a number of the challenges and issues. For example, just going back to the 24/7 example, the world is wedded to an end of day process in the financial world. We are wedded to that from a reporting perspective, regulatory perspective, accounting perspective. To actually move to a seamless 24/7 kind of world has a whole host of challenges that need to be resolved out there, and in those challenges, a number of them are risks. I think Tony mentioned the kind of one that people are most concerned about is the emergence of financial crime. That's clearly a major concern that people need to resolve. They need to actually be comfortable with the digital identity. They need to be comfortable with the business models that may, come out of the use of digital assets. Be that DVP, PVP, DVD, for example. What are the implications for this and the risks associated with that going forward? So, as I say, in summary, I think we don't know enough about the future until we actually push forward and really understand what those challenges are.
That's great. Thanks, Philip. I like the reference to DVP and DVD and that as well. Tony, just coming to you. I mean, looking not so much from the back office side around risk, but from the front office side, what do you see as the opportunity for this? And I'd like to answer the question in two ways. First of all, the business opportunity for a bank like Citi, and then second of all, for you as a consumer customer of a retail bank, what do you think excites you the most about programmable money and how you individually would be able to use it?
Yeah, taking the second one first. It is not entirely clear yet what are the compelling use cases for programmable money for a retail customer. But having said that, we have to realize that many payments use cases that are now universal or huge didn't exist before. So if you look at all of the payments related to the sharing economy, through ecosystems like Airbnb, all of or Uber indeed, the creator economy payments, the influencer economy, none of these payment types existed before. So, really what's going on in the background is that the digital economy is burgeoning, and it's only in the foothills of its development. And new economic forms are being created, new business models are being created. The question is, do the existing traditional finance rails meet those challenges? Do they meet those requirements? Because the danger is that if the traditional finance rails and the regulated rails don't meet those needs, then the vacuum will be filled by unregulated alternatives. And I think you can see this by looking back in history. So, even with Bitcoin, the idea was that we need some form of global instantaneous money movement system. The idea with some of the initial stable coins coming out of big techs is, can we turn these big tech platforms into commerce platforms? And actually, it's very difficult to do that with existing rails, and therefore we have to create a new instrument, a new stable coin that would be digital native and live on social media platforms. And even within the crypto ecosystem, stable coins filled a gap because it was so difficult for those players to access traditional rails. So, long way of answering the question, but it's at least interesting to explore the possibility of having a new rail. And we're not talking about a new rail to rule them all. We're not talking about a new rail to suck up all the transactions in the world. But there could be an industry use case for having a shared ledger-based programmable payment system, perhaps one that's even multi-asset, perhaps one that's multi-currency. And that might stand us in good stead for meeting those needs that otherwise could be filled by unregulated alternatives.
Those are really good points. It's almost like making a choice between where we're going in the future, and people have different opinions about which way to go. Bitcoin Maximus would disagree with a lot of what you said, but I think we've had those conversations before. Dhiraj, I mean, we're coming towards the end of the webinar session today. And so I just wanted to come to maybe some final thoughts from each one of you, slightly different questions though. Dhiraj, from your perspective, what are the key things that the industry is not talking about? What are the key questions that we need to answer that aren't being talked about currently in this space?
I think I can think about below, right? I mean, one is, I think, with Tony mentioned, right, that what are the current challenge in the existing payments rail? What kind of use cases or payments type we are not able to support, because whenever even there is a programmable money, as an instrument is there, but this will be an underneath of a payments use case, right? So what is the purpose of this specific initiative? So to actually complete the whole use case, we have to think about that, where are the customer touch point, how the settlement is happening, what are the data compatibility within these existing system, and how actually we can bring the solution to the life. That's one. Second one is, I see that and with few exceptions, right, the focus is still on the POCs, pilots, and MVP. Yeah, and I see the gap has been increased between initiative and the execution for a fully scaled commercial viable solution till now, right? And and Tony mentioned about it, right? That we are talking about achieving the tech side of it, right? The tech side accomplished. There is a lot of accomplishment we have achieved from the tech side, but on a practical purpose, whether it's a viable, it's a regulated. So we still have to think about those data sharing, risk, antitrust legislative, government framework, and how we can ensure that those tech accomplish what we have made surrounding these initiative, bring to a commercial aspect with a full-fledged of implementation globally. And I think the third one is still a little different, but from the programmable money, but still it's relevant, because I think what will happen in future, and we are seeing that although at the mass scale there's a less awareness of the tokenization of assets, but what we are seeing that tokenization of real assets is a real thing, and in few years the industry will be very different than today. So I think these are the three points I want to summarize the question which you asked, Janan.
Philip, I mean, coming to you, Dhiraj raised a number of the challenges that are out there, and the fact that we are in pilots for a lot of this. I mean, when will this be the new normal? Are we looking 1 year down the line, 3 years down the line, 5 years down the line?
Well, I guess it comes back to your understanding of programmability and what we take away from that and what we mean by that, and that's kind of a whole discussion. We could spend all day talking about it, frankly. But from our perspective, we're rolling out some form of programmability, the third quarter of this year, where clients can use and get value. Is that something that, to your point, a blockchain maximist would think was a genuine programmability, description of their meaning? Probably not. But does it bring value to our clients? Absolutely. So, it's kind of a journey I suggest we're on in terms of maturity, and we'll do some things that we can do today in a pragmatic sense that brings value. And going forward, we'll explore, what the journey looks like and where we end up. Is it, to Tony's point, kind of what networks are going to be supported, or what networks will we support? I think from my perspective, the challenge out there is given the size of the prize, everybody, as we've known historically, will want to think that they could be the answer to the solution, and it's their platform or their network is the right answer. So there's probably going to be too many platforms to be supported, and there'll be some rationalization over time, and coalescing around 2 or 3 of those platforms that make sense, where there's a significant amount of liquidity and activity, and then a very long tail of others. So I think that's something that we'll see over time. Now, is that 18 months out? Is that 5 years out? From my perspective, the jury's out. I think if it hadn't been for some of the challenges in the crypto space at the end of last year that are well understood and the implications are well understood, we probably would have got there far sooner. But given those challenges, that's caused a nervousness in the regulatory landscape, that they want to check and validate every capability in the, as I mentioned earlier, the unintended consequences of activities. I suspect it will be longer than we would like. Having said that, my experience of technology over the last 20 years has been, if you've said something would take place in 10 years, it took place in 5. If you said it took place in 5, it took place in 3. So that acceleration of, to the end point has been rapidly shrinking. So where we might think something might take 5 years, it takes 1 year to be deployed. I think we should be cognizant of that. But given that we are talking about nation state sovereignty challenges and issues, when we're talking about these subjects, my instinct is it will take longer than we would like if we wanted to get to the kind of future point. But it's probably sooner rather than later, if that kind of makes sense to you.
Yeah, that does. I have to point out, as well, that we're in the financial industry, which isn't known for being super speedy and getting to the destination in a lot of this. Tony, for the last word, I mean, when we revisit this topic at Cybos in Toronto later this year, if we have this webinar again this year, what would be the one thing when we look back at this point, say 2 years, 3 years out, what would be the one thing that surprises us about the space? What is the one thing that that you think will happen that it really just isn't in our frame of reference at the moment?
So I think that it's quite possible that the industry realizes that there's a space for, let's say, a regulated layer 1. I think it's going to be quite difficult in the short term for the regulated space to move into public blockchains. And the hurdle I've already mentioned, which is TPRM, and there are very specific issues with some of the blockchains. So, for example, it's very difficult for a responsible bank to be on an infrastructure like Ethereum, where gas fees arising from that activity may be paid to sanctioned entities. So that's a very difficult thing to overcome in the short term. Having said that, ultimately, if regulated money does not move into these venues where commerce takes place, then unregulated money will fill those gaps, and that's something that we really need to consider. But I think that in that short-term time frame, the industry may come to realize that there's value in having a layer 1 that we assemble around. Now, I think there will be more than one of them, but not dozens. Perhaps 3 or 4 of them that we coalesce around. And so, the exploration of this tokenization thesis, I think there will be a number of milestones, but those milestones need to be built on people demonstrating a clear delta benefit of operating on a shared ledger versus messaging between individual ledgers. I think those milestones most likely will come in payments and also in the tokenization of existing legal instruments. So I think that there will be progress on exploring that tokenization thesis, and it's likely that we will identify some tangible benefits that are clear, that provide clear benefit over the types of rails that we have today.
Those are excellent points, and I love the idea of a regulated L1 that fits into the needs of the industry rather than fits into the needs of digital apes or digital JPEGs or whatever else we need. Well, thank you so much. I mean, we're out of time for the webinar, unfortunately, so I'd like to thank Philip, Tony, and Jiraj for their time today. This has been an amazing conversation. Many of you have been asking questions in the background. We haven't gotten to all of those, but we will respond back to you offline. But thank you once again for attending this Capra Asia webinar. We hope you found it informative. There we go. I've been talking too long today. And we look forward to seeing you on future webinars. Thank you so much.